Bitcoin just brushed $70,000, and the world is literally at war. Stay with me, because today's crypto market is one of the most intense we've seen all year. Let's start with the story that is driving everything else right now. Over the weekend, US and Israeli forces carried out strikes on Iran that killed Supreme Leader Khamenei. That is not a crypto headline. That is a world-changing geopolitical event, and the markets felt it instantly. Bitcoin immediately spiked to around $69,000 on the news, the classic flight to hard assets, before pulling back hard as reports of Iranian retaliation hit the wires. By Saturday, BTC had plunged to a weekend low of $63,000. That is a roughly $7,000 swing in a matter of hours. If you were sleeping, you missed one of the most volatile crypto sessions of the year. But here's what's interesting. Bitcoin actually held up better than traditional markets. US equity futures tumbled, with S&P 500 futures down over 1% and the Nasdaq falling even further. Gold ripped past $5,360 per ounce. Oil surged roughly 13% to around $82 a barrel. And yet Bitcoin, despite the chaos, bounced right back. By today, March 3rd, Bitcoin has staged a real recovery, trading in the $68,800 to $69,000 range as of this recording, up roughly 5% from those weekend lows. The market is sending a message that crypto, and Bitcoin in particular, is increasingly being treated as a resilient asset, even in moments of genuine global crisis. Over in the Middle East, the fallout from the conflict is also being felt on crypto trading floors beyond the West. Iran's largest crypto exchange, Nobitex, which handles more than 87% of all Iran-linked crypto activity, is experiencing a sharp spike in withdrawals. When a country faces that level of geopolitical shock, citizens move their wealth into digital assets. We've seen this pattern before. It's a reminder that for hundreds of millions of people around the world, Bitcoin is not a speculative bet, it's a financial lifeline. Now let's talk about the traders who got absolutely wrecked. Over the past 24 hours, more than $300 million in leveraged positions were liquidated across centralized exchanges. The overwhelming majority of those were long positions, people who were betting prices would go up. When the Iran news hit and Bitcoin dropped from near $70,000 to $63,000, those over-leveraged longs got wiped out in sequence, like dominoes falling. Trading firm QCP noted that while $300 million sounds enormous, the scale of the forced selling was actually relatively contained, suggesting that many traders had already positioned defensively going into the weekend. Bitcoin futures open interest has since climbed back toward $21.9 billion, which signals that new positioning is already beginning. But analysts are watching closely because large liquidation clusters are sitting around $65,000 on the downside and above $70,000 on the upside. Both levels matter. A break above $70,000 with volume could ignite a real rally. A slip below $65,000 could trigger another cascade. Meanwhile, Binance open interest has dropped roughly 25% since the start of 2026, and the Fear and Greed Index is sitting at a reading of just 10. That is extreme fear territory. Retail traders are running for the exits. But historically, and I want to be very clear, this is not financial advice, extreme fear in crypto has often set the stage for significant recoveries. While retail panic spread across the market, Strategy, the company formerly known as MicroStrategy, did exactly what it always does. Strategy announced it purchased 3,015 Bitcoin, acquired at an average price of approximately $68,700 per coin. This is institutional conviction at its most naked. While the Fear and Greed Index screams extreme fear, Strategy is spending hundreds of millions of dollars buying the very asset that just got caught in the crossfire of an international military conflict. That says something. Whether you agree with their strategy or not, the message is clear. The big money is not panicking. This is part of a broader trend. According to a recent report from River, institutions, governments, and funds accumulated over 829,000 BTC throughout 2025, even as prices dropped from a high of $126,000 plus all the way down into the mid-60,000s. That's smart money doing what smart money does, buying when everyone else is frozen in fear. Here is a headline that I think is being underreported today, and it could be the most important thing we talk about. JP Morgan analysts have stated that U.S. crypto market structure legislation, specifically the Clarity Act, could be approved by mid-year 2026, and they believe it could become a significant positive catalyst for markets in the second half of the year. Think about what that means. Regulatory clarity in the United States would unlock a wave of institutional capital that has been sitting on the sidelines for years. Pension funds, endowments, insurance companies, entities that legally cannot touch unregulated assets would suddenly have a clear pathway into digital assets. The spot Bitcoin and Ethereum ETFs were just the beginning. If the Clarity Act passes, it redraws the entire map for how mainstream finance interacts with crypto. JP Morgan calling this out specifically in this market environment is not a small thing. These are the same analysts who track the institutional flows that move trillion-dollar markets. If they're putting mid-year regulatory approval into their base case, that is a signal worth paying attention to. Now let's talk about a legal development that just dropped today and could reshape the future of decentralized finance. A federal court in New York has dismissed a class action lawsuit against Uniswap with prejudice. That last part is critical. Dismissed with prejudice means the case cannot be filed again. It is over. The lawsuit had claimed that Uniswap allowed scam tokens and price manipulation by outside token creators to operate on its protocol. The court ruled that Uniswap is not responsible for the actions of independent token issuers. More importantly, the judge said that running a decentralized, open-source protocol does not mean participating in fraud. This is a foundational ruling for the entire DeFi space. For years, regulators and litigants have tried to hold the developers of open-source protocols legally liable for how users choose to use them. Today, a federal judge said no, the protocol is separate from its users. This logic, if it holds and gets cited in future cases, is a legal shield for every decentralized protocol operating today: Aave, Curve, Balancer, you name it. For Uniswap's native UNI token holders and for anyone who believes in the future of permissionless finance, this is genuinely significant news. It doesn't mean DeFi is out of the regulatory woods entirely, but it is a major win. Let's run through the altcoin market quickly, because not everything is moving the same way. Solana is one of the stronger performers today, climbing about 1.88% and continuing to hold up well. Developer activity and on-chain metrics for Solana remain strong, and the asset is increasingly being treated as a high-conviction play by institutional desks. Ethereum is up roughly 1.4 to 5%, depending on the time frame you look at, pushing back toward the $2,000 to $2,100 range after a rough few weeks. Binance Coin is showing steady gains of around 1.78%. Bitcoin itself is up close to 2% on the day. The notable underperformer? Dogecoin, which is actually in the red today, down about 1.53%, while most of the major assets are in the green. No single catalyst explains it. Doge has always moved to its own rhythm. On the AI token side, Virtual Protocol is having a standout session, up nearly 9% in the past 24 hours and outperforming the broader market by a wide margin. The AI crypto narrative continues to attract capital, and virtual is one of the tokens benefiting most from it right now. Here's a story that serves as a cold reminder of what happens when hype runs too far ahead of fundamentals. NFT floor prices across nearly all major collections have crashed more than 90% from their 2021 and 2022 peak levels. Bored Ape Yacht Club, which once had individual NFTs selling for over $290,000, with a verified peak close to $420,000 in May 2022, now trades in the range of 4.5 to 6 ETH, which at current Ethereum prices works out to roughly $9,000 to $12,000. We're talking about declines of 95% or more from the absolute highs. This isn't just BAYC. Azuki, which topped out around $110,000 per NFT, has seen similar collapses. Critics are once again calling the entire NFT boom a bubble that has now fully deflated. Supporters point to communities like Pudgy Penguins as evidence that the space still has engaged, loyal holders, and that current floor prices represent opportunity rather than defeat. The truth is probably somewhere in between. The speculative mania is gone. What's left is a much smaller, more committed community of people who actually believe in digital ownership. Whether that's the foundation for a real second act or just the last echo of a fading hype cycle is one of the more interesting debates in the space right now. Let's zoom out and look at what the analysts are saying about where all of this leads. Macroeconomist Henrik Zeberg laid out his March 2026 price outlook this week, and it is aggressive. His primary scenario puts Bitcoin in the $110,000 to $120,000 range this month, driven by a shift from fear to greed, continued ETF inflows, and ongoing institutional adoption. His secondary scenario, which he assigns a 25% probability, goes even higher, $140,000 to $150,000 if the broader cycle extends. He also sees the ETH to BTC ratio moving toward 10%, which would put Ethereum somewhere between $10,000 and $12,000. And he names Solana as the high beta play of the cycle, with a target range of $350 to $500. Now, to be clear, these are price targets from a single analyst with a specific macro framework. They are not guarantees. Bitcoin has a history of defying both the optimists and the pessimists. But the structural case Zeberg builds is worth understanding. ETF inflows tightening supply, institutional adoption creating baseline demand, and a potential shift in sentiment from extreme fear to aggressive buying. Separately, Samson Moe of Jan3 pointed out that Bitcoin is currently trading 24 to 66% below its historical trend compared to gold and global money supply metrics, while gold itself looks historically stretched. His read, the gap between gold and Bitcoin may be setting up for a significant reversal in Bitcoin's favor. And polymarket traders are pricing in a 74% chance that Bitcoin touches $65,000 at some point this year, a floor target that, given we're already trading above it today, suggests the market's base case remains constructive. Let's bring it all together, because today was genuinely one of the most news-heavy days we've had in a while. Bitcoin staged a strong recovery from its weekend lows, bouncing back towards $69,000, even as a geopolitical conflict of historic magnitude unfolds in the Middle East. Over $300 million in leveraged longs got liquidated, but institutional buyers like Strategy stepped in and bought 3,015 Bitcoin without blinking. JP Morgan says U.S. crypto legislation could pass mid-year and become a major tailwind. Uniswap won a landmark federal court ruling that sets a powerful precedent for all of DeFi. The Fear and Greed Index is at extreme fear, and if history is any guide, that's exactly when the most interesting setups begin to form. We are in uncertain times. The macro environment is complex, geopolitics are volatile, and the market is clearly not out of the woods yet. But the story of Bitcoin being resilient while traditional markets struggle is playing out in real time today. That is a narrative that matters. As always, do your own research, never invest more than you can afford to lose, and stay sharp. Thanks for watching Crypto Insight Hub. If you found this valuable, hit that like button, subscribe, and we'll see you in the next one.